Evelyn, and good afternoon, everybody, and welcome to session 4 of our Financial Best Practice series. I'm going to be joined today by my colleague, Tricia Williams, and we're going to be looking at some, I think, pretty interesting stuff, at least it is for me. We really designed these series of presentations to all sort of build upon each other. We start in the beginning, basic stuff, chart of account, allocations. You know, we moved on to reporting and sort of workflows, and we bring this all together in the final presentation. And we're going to take a look at standard financial reporting, some key financial performance indicators, data analysis. I'm going to show you some of the Excel-based data analytic tools. We'll do a little bit of review of that. Talk a little bit about communicating financial performance. We'll have our normal financial self-assessment at the end, and we'll set aside time for questions or discussion. So if you've joined us in the prior sessions, you know who I am. I'm the Senior Director for Fiscal Performance Improvement at CCSI. Been doing this for over 40 years. I think I'm up to 43 now. Started as a clinician and worked most of my career as a Chief Financial Officer. So we've seen this before. What do we learn? You know, what do we know? Environments change quickly. They can change dramatically. We really need a strong financial infrastructure to build upon. Accurate, timely, and well-organized financial data is necessary to navigate change. We'll take a look at a little bit of that today. What we don't want to do is be fixing gaps in our systems while we're in the midst of a crisis. You can't build the airplane while it's in the air. And so we hope that through these 4 sessions that you've been able to identify some areas that maybe you can improve a little bit, think about a little bit differently about how you're doing your structuring, how you're doing reporting, you're doing your analysis, who you're engaging in these conversations, and really beginning to make some changes that strengthens your performance and your infrastructure. So what's the learning objectives for today? Well, I hope you gain a little better understanding of standard financial reports. And we'll talk a look at balance sheets, activity statements, cash flow statements, and spend a bit more time looking at budget to actual reporting and some of the ways that I think about analyzing that data. Tricia's going to talk a bit more about key performance indicators. I underline key. Too many times I start projects with folks and suddenly they want to take a look at 32 metrics, 64 metrics, and that's not necessary. I think that part of what we'll talk about is really how do you focus in on what's important. I'm a firm believer in about 80% of what we need to be able to analyze can be based upon 20% of the data. I think that we can make we can understand our environment, we can model our environment. We don't need a huge amount of data to be able to analyze those really key drivers. I'd like you to become aware of some of the data analytic tools that are available in Microsoft Excel. I'll talk about this later, but there are some really very enterprise level data analytic tools that are on your desktop right now inside of Excel. Tools that in other programs, other applications are expensive, difficult to learn, difficult to use. Here we have some really very robust analytic tools that are right on your desktop right now. You don't need additional licensing. They're based upon some of the basic Excel structures and formulas, and they really will up your game considerably. And again, talk a little bit about how to communicate financial results in an intuitive and easy to understand, some of the data visualization stuff. So let's get started. Financial modeling, what is it? Well, I think about this as a monthly review of agency and program actual financial performance against best practice industry standards and internal budgeted expectations. When I talk about data analysis or data monitoring, I always think about I need to look at my data in a context. So understanding, looking at a metric and saying, okay, this is 42%. 42% of what? 42% of what we expected, 42% of ideal. What were we budgeted for? What's the industry standard on this? There needs to be a context. You need to understand your metrics as it relates to something else, as it relates to a standard, as it relates to a budget, as it relates to last month, as it relates to this time last year. And one of the key pieces in taking a look at your analytics is what is the context. And in the case of financial modeling, we're going to take a look at two critical reporting documents. One will be financial statements, and we'll talk about those in a minute. And the other will be actual to budget analysis by program. Now, there's other important financial reports, obviously. I mean, revenue cycle management reports are key reports for us to be looking at. You want to know what your aged accounts receivable are. You want to know what your denial rate. How well are you collecting? How well are your payers paying? Where do you need to focus your efforts? The other piece is efficiency of using available clinical staffing capacity, sometimes called staff productivity. One of the things that we do know for most of us are staffing and fringe benefits probably comprise between 70 and 80% of our costs. Our direct care staff, if you're a service that is billing, the amount of volume that our direct care staff generate dictates revenue. And even if you're grant funding, the amount of activity, the amount of interventions that your direct care staff are engaging in dictates the number of individuals you can serve. So I think about this piece as really measuring effectiveness and efficiency of the use of your direct care staff. Effectiveness is outcomes. Efficiency is volume. And I do a lot of financial modeling, and believe me, the most important variable in almost all programs is volume. It's the amount of activity that you are able to generate for the costs that you incur. And the other piece is revenue generation. Payer mix is huge. Again, if you're billing out services, you need to know what your Medicaid participation rate is. You need to know what your unit cost is. You need to know what your unit revenue is by payer. You need to understand what your mix is. It's all part of your ability to understand your bottom line. And then there's obviously unit of service volume, how that changes over time, how that's created at the individual staff level, how it interacts with your expenses and your revenues. And we'll talk a little bit about that when we take a look at our activity reporting. So let's start with the financial statement of financial position. These are normally statements that go to the board. These are statements that are normally reviewed or audited by your independent auditors. They go to grantors, they're year 990, they go to Charities Registration Bureau. So really the key set of financial statements that speak to the financial status of your organization. I think in many organizations, we put these together, maybe we'll share them with the board, but we don't really use these as an analytic tool. So I want to just sort of walk through a couple of the key points that I go through when I take a look at either my own financial statements or financial statements of another organization. So statement of financial position, it reports your organization's assets, liabilities, and the difference in the total. And it's really important for understanding an organization's financial stability and if they have sufficient cash and receivables to cover short-term liabilities, sometimes called the current ratio. So let's take a look. These are fairly stylized. You have assets, you have liabilities, and net assets. In net assets, there's a little bit different structures, but in most cases, this is exactly the same. So what I want to do is take a look at it in my current assets, how much I have in cash, what's receivable, what have I prepaid that is an asset and value to me. I've expended the funds in a prior period, but I'm going to recognize the asset in the current period. I may have land leasehold or equipment at net of depreciation. This is the positive side of the ledger. This is the value that I have: cash, investments, prepaid equipment, those kind of things. The next section is going to be your liabilities. That's what do you owe out. And here's cases if you have accounts payable. You may have payroll payable or accrued payroll, accrued salaries and expenses. You may have reimbursements that you need to make to a funding source. You may have deferred revenue from prior periods that you haven't used yet. So this is sort of the negative side of the ledger. And then, what's the balance at the end? How much assets do you have over liability? And so a couple of the key things I look at here is one thing I do is I take a look at cash. So how much cash is on hand? And you'll see when we go to an activity statement, I can say, okay, what's the average amount of expense? So I could take a full year's expense, I could divide it by 365, and I could figure out how much cash the organization spends on a daily basis. I can then compare that to the cash that I have on hand. And do I have enough cash on hand to cover my operations? I reviewed a financial statement not too long ago. I did this analysis, and lo and behold, the organization had about 4 days cash on hand. And from the statement, it looks like they weren't going to cover cash flow, or they didn't have cash flow to cover their next payroll. It's a bit of nuanced, but it certainly gives you understanding about the organization. It also gives you an understanding of how much they have in reserves. I mean, a lot of organizations ended up in, say, in the COVID situation, not being able to generate enough revenue from operations, but your total net assets, particularly your unrestricted net assets, tells you how much that sometimes you hear this called as a rainy day fund. How much assets do you have that could be used to cover operations in a pinch? And so these financial statements, I think, give you some really valuable understanding of long-term sustainability of an organization. And do they change a lot month over month? No, maybe not. But do they provide useful information not only at the governance level, but at the operational level? Yes, absolutely. So that's the first piece that I always take a look at, is a statement of financial position. This is a bit more, I think, operational. And many of you may be familiar with audited financial statements that are done once a year. But most organizations should be running interim financial statements. Those are financial statements on a monthly basis. So you have this information month over month. So you can evaluate changes, you can understand a little bit about cash flow, you can have better understanding about your receivables. So here's a financial statement of activities. It shows your organization's revenues and expenses and net surplus or loss of the organization at the end of an accounting period. Accounting period could be a month, it could be a calendar year, it could be a fiscal year. And it's a critical analysis of organization's financial performance and if the organization has experienced a surplus or a loss. So here's an example. We have supports and revenues. We have fees and grants. So in this case, I got about $900,000 in client fees. I've got maybe a little over $200 in grants. My school-based program generates a little bit. I have some contributions. I had a release from some restricted net assets. So My total support and revenues for this period is 1.2. So I'm looking at my expenses. Well, my program services, was 900. Management was 135, so I had total expenses of 1.1. So what does this tell me? This tells me that I'm generating a margin of $71,000. So my expenses are in excess of my revenue, or my revenue is in excess of my expenses. So it shows me what my net assets were at the beginning and what are they. So at the beginning of the year, I started with net assets of $107,000, and so far this year, I've increased that by $71,000. And you could create an operating margin from that. What's the percentage of margin that I'm generating? The other thing I look at in these kind of statements is how much of revenue is generated from operations and how much of the revenue used to support operations is coming from other sources. One of the things we have to be careful about is how much money how much of our expenses are we covering from revenue sources that may be a little bit more difficult to predict? How much of the operations are we covering from fundraising? Fundraising could be variable. What did everybody find out? In 2020, fundraising dropped precipitously. So if you were relying on fundraising to fund operations, now you're in a period where maybe your client revenue is down, your donations and your fundraising is down, and that creates a more difficult position for you. So I want to take a look at, in this case, I've got operations of 1.12, and between my grants and my client fees, I'm covering it. And so, okay, I feel pretty comfortable with that. Now, this normally statement of activities is aggregate across the agency. When we begin talking about actual to budget, we'll start looking at that at a program level. So that's this piece. Let's see if I can. Okay. Oop. And the final is a statement of cash flow. Statement of cash flows are sometimes difficult to understand. You've got a lot of ins and outs. I'll be perfectly honest with you. I don't analyze each of the ins and outs at a great deal of detail, but one thing I do look at is the line there says net cash provided by operating activities. That is how much of my cash that I'm generating is coming from operations and not other sources. So if we flop back here, if we go down, we see that, let's go here. We see that we generated $71,000 in net assets. 68,000 of that came from operating activities. So what I want to do is make sure that our operating activities, the amount of cash generated by operating activities is covering our costs. So those are the kind of statements that normally go to governance. They may not look at them on a monthly basis, but I think that they are the fundamental financial statement that other entities are going to use to evaluate the financial stability of your organization. You're going to send those to the state. They're going to be part of your 990. Grantors are going to require them. Donors are going to want to look at them. So understanding what they are, picking out and understanding where the strengths and weaknesses are in those statements, and setting goals to address the weaknesses in your statements I think is critical. And this is something that we should look at a regular basis. All right. So the piece that we're probably all more familiar with is actual to budget analysis by program. So what's a actual and budget analysis by program? So these are reports in a format and how each budgeted program is performing in relation to your expectations. So we go through all this work to build our budgets. I really think about budgets as a strategic planning document. I was working with an organization on their budget today, and we had this conversation about, all right, what are you thinking? Well, we have a program that we haven't been able to generate the revenue we need. We're a little bit overstaffed. I said, okay, so strategically, what are you going to do? Well, we haven't really decided yet, but we may have to lay off some of our staff. Okay, that's fine. But the budget allows you to be thinking about what are the moves that you potentially need to make next year. Where are your opportunities? Where are your pain points? And it allows you, before you get into the year, to begin thinking about what you're going to need to do. And then once you get into the year, you have to evaluate your actuals against that. You need to know if we built some strategic, if I'm starting up a new program and I built my startup into the budget, I need to be able to evaluate how well I'm doing against that. If I have a program that I'm trying to increase volume, to increase revenue generation, I have to be able to monitor how well I'm doing that. If I have a program that I need to bring my unit costs down, I need to be able to monitor that against my budget. So we set our expectations, we set our benchmarks, we try to understand what we're going to need, and then we need to watch how well we're doing, because we need an indicator whether we're off or on, ahead, behind, so we can make decisions about what we need to do next. Now, when reviewed regularly, they drive decisions. They ensure that the organization's meeting its individual program and agency financial goals. Everybody's building budgets that are, at the very least, break-even budgets. You need to monitor that. You need to monitor that in the context of what did we expect. And then we'll take a look more closely at then a root cause analysis of when we're off. And I think it's one of the most critical tools in evaluating financial stability and sustainability. I can't think of a circumstance where we would not want to analyze actual to budget. So these next two slides, I think, as I was reviewing this today, I think that these are probably the two most important slides in the presentation as it relates to financial monitoring. So let's talk about these in a bit more detail. So the first point I make is make sure that the report is created as soon after the close of each month as possible. So let's think about a scenario. You have a budget, you have some strategic pieces in that budget, and you start your year, and then you don't evaluate that until mid-year. Well, guess what? You just lost 6 months of opportunity to be able to fix, address the problem that you've identified through this analysis. My rule of thumb, and people disagree with me on both sides, but I believe that you should have your financial statements done 10 days after the close of a month. I tried to always do that sooner. My goal was 8 days. Things need to close out, and I understand that. And, we always waited till progress notes got finished so we can make sure that we grabbed in the proper receivables and all of that. But if you can't close within 10 days, then you have a workflow problem, and you need to begin taking a look at that. You cannot leave time on the table. And so make it 10 days and make that review very shortly after that. And then review it with the staff responsible for the program's financial performance. Make this a mandatory monthly meeting. Mandatory monthly meeting. This is not something that anybody can blow off. First of all, you have to review it with the staff responsible. I mean, it's the only fair thing to do. You're holding folks responsible for financial performance, where you have to provide them with good information. It has to be accurate. It has to be timely. You have to help them understand it, and then you have to work with them around making the decisions that are necessary to make the changes that are necessary. When I was a CFO, we had these meetings. We had a meeting every single month with each of the program directors, and some of the programs that we were working more aggressively with, the supervisors came to that meeting. We analyzed the data. We knew what we were looking at. We agreed upon any changes or performance activity we need to address, and we monitored that again the next month. And it was a team effort of understanding what the budget are, where we are, having a joint decision about when and what kind of intervention is necessary, and then watching how well that works, and hopefully in many cases celebrating our successes. And when you have a variance between actual and budget, you have to do a root cause analysis. And I'll walk you through that process in the next slide. You have to determine what factors or variables are at play. Sometimes the cause is not as obvious as they seem, and it's not always the first thing that you come upon. Sometimes, and I've seen this time and time again, people are doing a root cause analysis, and they're sort of going through the checklist, and they come to a point and they go, oh, all right, that must be it, and they stop analyzing. Well, when you're doing your analysis, and you'll see this, is there are a certain number of variables you have to look at. Don't assume that there is only one variance that is, or one difference that is driving your variance. You have to drive through the, you coming to a quick decision about what the problem is. Look at all the variables. And because sometimes you're right, what you're looking at is causing your variance, but in many cases it's not the whole thing that's causing your variance. There's too many variables at play here to think that you can't analyze every single one of them to understand your root cause. And then when do you take action? I mean, sometimes you have to do something immediately, right? I got to address this. This is crazy. I mean, we're running off the rails, and we have to do something right now. Other times you look at it and you go, oh yeah, this is seasonal. You know, I worked in Buffalo. It snows in Buffalo. Sometimes it snows a lot in Buffalo. So we had snow days. So I may have had some seasonal pieces. That's okay. January is going to be low. February is going to be low. You could be looking at productivity, and everybody takes vacation in July, and so your volume goes down, so your revenue might go down. So you have to really take a look. And one of the things I do is I always analyze performance over time. I look at trends. Trends tell you so much. Trends tell you, so you can look at them. Okay, what was it last year? What were the trends? What can I project going forward? And knowing when you need to make changes is tough. One of the things we do a lot, though, is we wait too long. We say, oh, yeah, well, yeah, we're going to talk to those folks about this, and, we're really going to push, and next month we're going to see a significant change. Well, if next month doesn't show you a significant change, or even a minor change, in the direction that you're working towards, then maybe you need to be a bit more aggressive. So it's a bit of an art. When do I need to change? But you need good data. You need timely data. You need accurate data. And you need trend data. So here's an example of a actual to budget report. Not just at a program level. So there's all kinds of ways of doing this. This is just one example. But these are really the components that I think are important to take a look at. So here's an example of a mental health clinic. So the way that this works is that, so my target is 67%. What does that mean? Well, that means I'm 67% of the year. So I'm going to expect that my percentage target is around 67%. So I've got a prorated budget of $288,000 in personal services. I've got an actual of $292,000. So I'm going to start taking a look at my targets. Well, I'm a little bit over in my expenses against where I thought I should be. I'm a little bit over in fringe benefits. Well, fringe benefits run pretty closely to personal services, so I wouldn't be surprised about the fringe benefit costs, but I may want to go and ask myself a question about the personal services. Why am I? It's not a lot over, but I'm 67% of the year. I'm a little bit more than halfway through the year, and if I project this out, it may be a little bit more of a expense over budget than I wanted. So at the very least, I need to know why. Doesn't mean you're going to change anything. Could have been anything. Could have been that I don't know, that somebody left and you had to pay out 4 weeks of vacation, for crying out loud, and you had to hire somebody in their place. And so you incurred additional expenses in that period, and although you weren't getting any additional units of service from that. So like I said, it's not necessarily something you need to change, but it isn't something you need to understand. My rule of thumb is anytime I went in to have a conversation about budget to actual, I understood what each of the variances were. I understand what caused them. I understood how serious they were, and that really shaped the conversation that I had with the team. So I'd ask a question about that. Then I go to other than personal services, OTPS. I'd be proud of myself that I got that one nailed. I thought I'd do about $22,000. I'm at $22,140. Okay, I'm a couple bucks over, but you know how that works. That's nothing. That's pretty good. Equipment and timing, that's fine. I'm a little bit under. I get to property and I go, budgeted 8,667, and what? I only have $2,500 allocated or charged off to property. Well, what's that about? That's only 19%. So I've got a couple of issues that might have happened here. So when I put together property and I figured out my allocation at the budgetary level, something significant could have happened since then. We could have closed a portion of this program. We could have moved a portion of this program somewhere else, so it's falling on some other kind of cost center. Or I could have built out an allocation formula. Remember how important cost allocations are to understanding unit cost. I could have built a cost allocation formula that never made its way through my allocation models. So I'm under allocating expenses. Now, if that's the reason, now I have cause for more concern because I'm $2,000 over what I'm budgeted, but I've also seemingly under allocated about $6,000 in cost. So it's a possibility that I'm not really 2,000 over. I could be actually 8,000 over. So I need to go in and take a look at that property and see what's happening. Because if it is a misallocation and I should have $8,600 in costs, then I need to know that because I have more of a problem than this analysis currently shows. All right, so that gets us through expenses. So let's go down to revenue. Now you'll see expensive, I break down by line item. It's just the way that I do thinking. I think it's helpful to understand. I think in working with program managers, it's helpful to understand how these different aspects of cost contribute to the overall cost. One of the things that's always important is to say, look how much of your cost is in personal services and fringe, and look how $22,000 in OTPS. So other than personal services, do I care that you're $500 over in your office supplies? No, I don't. Do I care that you're $3,000 over in personal services? Yes, I care about that. So it helps sort of a context of where costs live and what it is that we really need to focus on. We should focus almost all of our time and effort on personal services. Right. So total revenue. Now, I put this as a single line item. I certainly would advocate for providing budget and actual at the payer level. It doesn't have to be at a very discrete or granular payer level. It could be your basic Medicaid, commercial, Medicare and private pay. I think that's a useful breakdown to take a look at. And so, but in this analysis, I didn't do it. So what do we have here? So we had a budgeted of $470,000. What am I looking at? I'm looking at $461,000 actual. And all right, this doesn't tell me much. What it does tell me is that my revenue is down. So my expenses are up. My revenue's down. My expenses could be up more than I'm looking at right now. I have to figure out that. My revenue's down. So I had expected that I was going to have a small loss at this point of the year, $611, but my loss is $10,857. Okay, so let's move along. Units. Well, I was budgeted for 4,100 units, but I only have 3,500 units. I'm at 57%. There's my problem. I've increased my personal service costs, but my units of service costs are well below what I've expected, and I'm generating less revenue. Thank you very much. I figured it out. We have to address units. There's a problem. That's not quite all the answers, because let's take a look. Cost per unit, that's simple. Yeah, I understand. I should have been at 114, but I should have had 4,100 units. I only had 35, so I'm at 134. That makes sense. But let's take a look at revenue per unit. I had budgeted 113 revenue per unit, but I'm at 131.71. I'm generating $17 more per unit. What is that all about? That doesn't make sense. And let's think about that. You're 10,000 over budget, but your unit revenue is $17 more than you expected. Holy cow, if there's a problem there, that $10,000 loss you're looking at is much larger, because this doesn't make sense. It doesn't make sense to me that you got a revenue of 131. On the other hand, just think about it. If my revenue per unit actually is 131, and I was able to generate 4,100 units at the cost basis that I have, I'd be generating a margin. So even in this very simple analysis, there are a number of questions that came up here. What's up with property? Is my total expense actual really a lot higher to budget than it looks like? Is my variance and surplus to loss, is my margin and my loss higher than I anticipated only because of units? Maybe. But what's happening with this revenue per unit? What if I have a structural problem and I'm assigning too much revenue to this program, and it really is 113? Well, if it really is 113, then I have a much more serious problem. So that's the root cause analysis. You take a look at every single variance and you understand it. And you understand it in relationship to your budget, and you understand it as it relates to where your different variables come together. Some people don't look at unit cost as a metric. I think it's a critical metric, and it's a critical metric because it's the point at which your volume, that is your unit production, and your cost intersect in an important way. Because, you know, the formula is you take your units and divide it into your cost. But if your unit cost is going up and your costs are going up, that means your units are staying the same. But what happens if your unit cost is going up and your units are actually going up also? Well, there's a variance there that doesn't make intuitive sense, so there's something else going on. So it's this mix between volume and revenue and expenses that help you understand a bit better of what's going on. So this isn't just a pure example of sort of a clinic cost per unit of service monitoring. So in this example, we were looking at 131. We started off the year at 130 in terms of cost per unit, really good. From January, went down in February. Then it started rising. So in March, we had a pretty significant increase. So in March, we said, okay, we've got something going on here. Let's take a look. Between March and April, we really identified what the problem was. We put together what we were going to do as an intervention. And then you'll see March to May to June, that worked. We flattened the curve. We had made changes. We had done a little bit better in monitoring, working with individuals around productivity. We held our cost structure flat. And so you see that dramatic increase between February and April was really flattened between April and June. Then we had June, July, and September. We went in and took a look in our data, and we got killed by vacations. I had somebody out on disability, and we had fixed costs and reduced revenues, and then that cost. But what we did find is in October, apparently the changes that we had put in place earlier worked. And so now my unit costs really started dropping down. I had a little bit of a uptick in November. Thanksgiving, it's going to cut down. You have fewer program days. So this is an example of what I was talking about before. When do you make changes? Some of them are structural. Some of them are seasonal. You need to understand. You need to dig into your data. You need to decide to make changes. And this really is one of the metrics that helps you do that. So here are some final thoughts on financial monitoring. Accurate numbers, timely, easy to understand, and review them regularly. I just can't emphasize that enough. Deciding when to make changes related to poor financial performance can sometimes be tricky. Map performance. I always used 18 months. I always want to understand across the longer time frame what I'm looking at. When you determine when to act, clearly communicate to staff what you're doing, why you're doing it, and use change management tools, clear communication, guidance, tools, mentoring, monitoring that is necessary to make those changes. And, of course, you can't effectively monitor and manage financial performance in isolation. It takes the team. It takes the finance team. It takes the leadership team. It takes the clinical leadership team. It takes supervisors, program managers. They understand what's going on the ground. You provide the data, find timely data, accurate data, make decisions, decide when to act, and then monitor the change. So that's it on financial modeling in a nutshell. So we're going to switch gears a little bit, and I'm going to invite my colleague Tricia Williams to come in and talk a bit more about effective data collection, KPIs, and then I'll finish up after she's done, talk a bit about business intelligence. So Tricia, take it away.
Well, thank you very much, David. So as you implied, we're going to talk about efficient data collection and the processing of those workflows. And I want to talk about KPIs. So this is our buzzword, right, that we've been hearing for the last several years. So we can move to the next slide about those KPIs. And so KPIs are the indicators that refer to a set of quantifiable measurements used to gauge a company's overall long-term performance. So we're talking about really the success of a company and how successful it's been. So they're specific to help determine really the strategy, the financial and the operational achievements, especially when we're comparing that to other businesses that are the same in our business sector. So let's think of, we're talking about finance, right? That is the point of this series. So KPIs can be financial in nature. So that includes all the things that David has been talking about: net profit or the bottom line, the gross profit margin, revenues, certain expenses, or the current ratio that we're seeing with the cash availability versus liquidation. So really all of our KPIs can be looking at different aspects. So a lot of times we think of KPIs when we're thinking of our clinical outcomes. I think it's really important that we shift our thinking, that it's really the entire business, that we're looking at the strategy, we're looking at finance, and we're looking at the operational achievements. So I have a question for everyone. So our next slide is our polling question. So Jocelyn is going to be fantastic, and we're going to set the poll, and it's how many KPIs, how many key performance indicators does your organization currently monitor? We're going to say, is it 0? Because that's going to tell us something. Is it 1 to 10, or is it over 10? So we'll give everybody a couple of seconds to complete that. And then we'll let Jocelyn present those results. All right. So we have a few folks that aren't monitoring any KPIs at the time. The majority of the folks that are on the call have between 1 and 10, and we have a handful of folks that have over 10 KPIs. And as we talk through this, you'll see kind of why I asked this question in the first place. So our next slide is really going to help us talk about, so what are the questions to ask when we're creating KPIs? So when we're creating KPIs, we have to remember that less is more in this situation. So really our sweet spot, our number of KPIs is usually around 5. Good KPIs, they provide objective evidence of the progress towards that achieving desired result. So you still have to have kind of this overarching goal of what you are hoping to achieve within your organization. It measures what is intended to be measured to help inform better decision making. So that goes back to that strategy and that strategic planning. It offers a comparison that gauges the degree of performance that changes over time. So as David has been talking about, he likes to look at trends. And, you know, when I was in that role in a clinic setting, that was what I was always going back to. I wanted to understand what was the trend, what had continued to happen. It can track efficiencies, effectiveness, quality, timeliness, governance, compliance, behaviors, economics, project performance. It actually can look at all of these different components of your organization. Good KPIs are balanced between leading and lagging indicators. So when we're saying a leading indicator, it's the precursor of the future success. A lagging indicator is we show how successful the organization was at achieving results in the past. So that's the lagging is your trend, and your leading is what we're hoping to look at. So what is that budget to actual? KPIs can be categorized in several different types. So you can have inputs, and those are they measure the attributes. So the amount, the time, the quality of the resources consumed in a process. There's the process or the activity measures that focus on how the efficiency or the quality or the consistency of a specific process is used to produce, you know, that specific output. So they can also measure the controls of that process. The outputs, so are result measures that indicate how much work is done and define what is actually produced. And then we also have the outcomes, so focus on accomplishments or the impacts, and they are classified as really that intermediary outcome, such as the customer brand awareness. Are they aware of what we're actually doing? And then the end outcomes, such as the customer retention. So that's what's driving, that's by that increased branding awareness. And then that last category is the project. So the measures that answer questions about the status of the deliverables and the milestone progress related to the important project or the initiative. So when we look at KPIs and what are the important questions to ask, we really look at these 7 questions. So the next slide, we're going to go through an example. And I love how David kind of set us up for this example when he was talking about budget versus actual. So what is our desired outcome? So our desired outcome, and actually it's not only that today we've talked about it in session 3 as well. We want 60% of billable to paid hours for our direct clinic staff. So really what is that productivity that we're looking for our clinical staff? Why does it matter? So this is the amount of billable services necessary to cover our costs. We say that 60% of those billable services are going to be able to cover the cost of our clinician, our overhead, and everything that goes in with that particular service. How are we going to measure the progress? We're going to create a billable to paid hours report. And we can see then where are we comparing to what we budgeted, and then what is the actual. How can we influence outcomes? So we've talked about this as well. We've talked about this in office hours with some folks, is how do we reward staff who are meeting and exceeding expectations by providing tools and training for those who are not. And then who is responsible for the outcome? Again, this talks about how do we involve everybody throughout the organization. So this isn't just finance hook to really be able to look at what's going on in those reports. It's all about how does the full team, the clinical team, the leadership team, the finance team, how do we all come together? And for this particular outcome, it's going to be that individual staff or that clinical supervisor that's going to be monitoring this expectation. How do we achieve it? It's that consistent and timely feedback. So as David was talking about, that reconciliation within 10 days, that means that we have billable notes in, that everything is completed in a timely manner, so we can provide that feedback back to the team of saying, hey, we fell down here. We need to maybe pick this up a little bit. And then how often are we reviewing our progress? We should be pulling out our ledgers once a month and sitting down with the team going over how are we doing so we can make those adjustments. So if we look at the next slide is really a way for us to start to look at, if we're going to say that we would like on average 75 hours each month as what our billable hours are. And we're looking at this particular, our friend Patrick here, and Patrick is meeting or exceeding out of the 7 months that we have, 4 out of those 3 months. Do we need to look at what's going on? So we're seeing that in April, we're falling down a little bit. We're seeing in July, we're falling down. We're seeing in February. So what are some of the things that are going on in February? It could be, well, February is a short month, right? So our billable days in February are not necessarily the same as if we go into March, which has many more days of billable services. When we look at April and we look at July, are we dealing with any kind of holidays that are going on? We tend to have in April, we have some religious holidays that usually take up some time. We also have some school closing. So people taking off because there's stuff going on and they're not available. And then 4th of July, we're in the summer, we have a holiday involved, and is that what we're seeing? So do we need to look at, do we want something that's consistent across the board with what the expectations are for each month? Or do we need to look at that there needs to be a variation and a variance even with how we're actually reporting some of this information? And at the end of the day, is it a wash because we know that there are also going to be months that have more billable days, that there tends to be less holidays? So those are things to consider as we're looking at these examples and these KPIs. So next slide is talking about how do we make things actionable? How do we move this stuff forward? So how do we whittle down the KPI? So we had 24% of the folks on this call who have 10 or more KPIs. So if we have that many, it might really be difficult to track all of those KPIs. How do we start to identify what is important? Because if we can't track them, we can't make them actionable. So less is more when it comes to really gaining value from our data. To be effective, having more than 5 KPIs tied to a single goal at any given time really kind of distracts us from being able to monitor. So the quickest way to identify, your top 5 KPIs is by doing really a purge. So we rank and then we reduce our KPI counts based on really what is their impact? What is their impact on the goals that we have? We identify our overall business goal. We make sure that we are using KPIs that are directly aligned to those goals. And then you can even go as far as to actually assign weight to your KPIs to understand what those impacts are. And then you really can justify why you said, you know what, we're not going to review this for right now. We're going to focus on these 5 because these are the most important and these are actually going to drive our goals. A KPI should really enable anybody in our organization to easily understand really the following components, all right? So what actions can be linked to the KPI? How are we measuring the KPI? When should action be taken related to the KPI? So, as to David's point, we should be taking action immediately. As soon as we see something that's looking a little wonky, if we want to give it a month to fix itself or correct itself, sure. But after that, we should be responding as soon as possible. What does success look like for that KPI? So, I think that's a really important question that we should always be asking anytime we're looking at what these measures are is, really, what does truly success look like? And then some additional suggestions when we're looking at KPIs. If we're going to make these actionable, we have to assign owners. We have to assign somebody that's going to be able to monitor them. We want to break down the deadlines and the timelines with shorter intervals because that allows us to really own those opportunities for immediate action and really encourage that accountability and that proactive behavior that we're looking for. It is so important to be transparent and to share this information. If we don't share it, then folks aren't going to understand that they're responsible. And we have to do this in a way that's transparent and also allows for growth and allows for some skinned knees every once in a while, because we don't want people to be so paralyzed by fear that they're not meeting it, that they keep getting into a cycle. We want to make sure that people understand that this is a progress and that we're working towards this goal together. Make adjustments as needed. So as we just saw in that previous slide, we have some things going on where this particular Patrick person is making 4 out of 7 months, but we might have to adjust our expectations because we have some other things going on in those months, and then those check-ins on a regular basis. So there's just one more slide. And again, this is just to kind of help us look at what a dashboard could look like and what are some of the ways that we could be monitoring. So this dashboard really, and they're all linked together. They all link to that larger goal of understanding what is our financial performance. We understand that links to our financial performance are really about turnover rates, about productivity of the people that we're supporting and serving. What are those denials? And what is that customer satisfaction? So these are going to be our top 5 that really flow into what is our financial performance. So thank you, David, for giving me the opportunity to chat about KPIs today.
Well, thank you, Tricia. And I did see a question did come through the chat. Please feel free to chat in any questions to Tricia or myself you may have as we go along. We will be saving some time at the end to answer some questions. So we're going to finish up with some concepts around business intelligence. Just as we've been hearing KPI as a buzz phrase, you may be hearing business intelligence as a buzz phrase also. But I really like this concept, and I like this definition. It's a term that refers to a couple things: skills, processes, technologies, applications, and practice. So you can see that we have a number of different components here. It's a skill set, it's workflows and processes, it's technology and application supports, and it's the practice that we implement, and it's to use to support evidence-based decision-making. This is data-based data-informed decision making. And we can really conceptualize it around a couple of different components. That's gathering information, storing information, analyzing it, and providing data that helps users gain insights and make better fact-based decisions. So when we talk about this business intelligence, many times we just think about a very narrow focus. It's sort of the analytics, but it's not. It's the larger system. It's the skills we need. It's the processes we need in place. It's the technical pieces that we need. And it relates to how do we grab information? Where do we store it? How do we keep it safe? What are our analytic tools? And how do we visualize data for our end users in a way that is useful? Now, all of the examples that we have shown here today are Excel-based data visualizations. And I'll talk a little bit about those tools in a second. But here's some of the ways sort of I visualize and conceptualize business intelligence. You start with gathering data. Data can come from a number of different data sources. It can come from your billing data. It can come from your electronic health record. It can come from psyches. It could come from your payroll system. It could come from your general ledger system. It could come from your HR system. It comes from an external data source. It could come from your RIO. It could come from a whole number of places. But you have to gather it and transform it, and we'll talk a bit more about that. You have to store it. It's got to be stored in a structured format. It has to be safe. Once you get it in, it has to be somewhere. Then you have to visualize the results. You have to build an analytic environment and a set of visualizations that can support insights in making decisions. We don't talk about really gaining insights from your data as much as we should. Really, for lack of a better term, just playing with your data generates insights. You see relationships you didn't see before. You see trends that you didn't know were there. It's a process that, you take the data and you may not know what you're looking for, but you may be surprised at what you find. And then, of course, there's a piece of providing data in a way that people can use. So here's another Excel-based example. So this was an outcome metric. What was the outcome metric? We wanted initial evaluation performed within 10 days of initial contact. So let's take a look at the little pivot table up in the left-hand corner. We put this project together in June. We trained everybody. Everybody was going great. We were doing bang up. We were 100% in June. We were 100% in July. We were 100% in August. You'll see at the top that was our goal. We clearly have defined what our objective was, what our goal was, and we began monitoring it. September, we fell down a little bit. Well, 1 month, you're not going to go in and make huge amount of changes within 1 month. But then October, all right, we fell off the mat. October, November, December, and what are we seeing? We're seeing a downward decline. Well, the team wasn't meeting regularly. And we weren't looking at this data regularly. And somebody who was looking at it kept saying, come on, guys, we're falling down. And then finally, everybody got together in late November and December, identified what the problem was, made the changes that were necessary, and lo and behold, in January, we came back up. But there's also ways of generating some insights from this data. So one of the things is we're able to filter on program. So is one program doing better than the other? If not, which one is? Who's driving failures and who's driving successes? And then we may want to look at this by payer. We may have a performance contract against us from an individual payer. So are our payers different? And then, of course, what we want to know is what is the average? What we wanted to do was perform within 10 days of initial contact, but what we were getting was 37, and within 10 days is 35. That average number of days is just another component that we want to take a look at. So this is just an example of how you could generate a key performance indicator. This was against a performance-based contract. How we would generate data, how we would monitor it, and then how we would make changes. So what do most of these visualizations depend upon? They depend upon the business intelligence tools in Excel. Now, some of you may be very much aware. I would start, although I start with pivot tables on the left here, I would start with a table. A table is a way that you can take a large amount of information, structured information. A row is a record, a column is a data element. You can filter on them, you can sort them, you can do subsets, you can do all kinds of interesting things with tables. When I do data insight or data validation, I always start with a table. Where are there holes in my data? Am I seeing gaps? Am I seeing inconsistent responses? All kinds of things you can figure out just by using your tables. The next set of skills is pivot table. This is a fundamental functionality in Excel. How can you take a large amount of data and aggregate it and put it into meaningful aggregated structure that is easier to understand? So as an example, say I want to know how much revenue is generated by one of my payers each month. Well, a table you could do that, but you'd have to keep filtering and going back and forth, and it gets a little bit of labor intensive. But what can I do is I can run a pivot table. And in that pivot table, I can say, just filter on this payer, add up the total dollar amounts that we billed, and show it to me by month. Well, suddenly, and that could be 10,000 records. It could be 20,000 records. It could be 1 million records. But what you're able to do is you're able to take this large amount of data, you're able to apply a filter context to it or filter it, and then sum it or average it, do the max, do the min, but it allows you to take a large amount of data and put it into an understandable format. Now, the last two tools are tools that not a lot of people are aware of, nor are they using. The first is Get and Transform. It's a set of functionality that allows you to, it's a queries tool. It allows you to connect to a data source, but it also allows you to transform that data. For you folks out there who access data directly, let's take a general ledger, accessing your trial balance. Well, there could be a lot of holes in that, or the report could come out with headings on it and subtotals on it, and that's not what you want. You want one record, one transaction per row in your table. And so your Get and Transform allows you to connect to that data to transform it. You can filter out those spaces. You can drop down out the columns you don't need. And you can put it into a workable environment. And then the fourth is something called Power Pivot. Power Pivot allows you to do three things. Well, it allows you to do a lot more than three things. But it allows you to take the data that you access through a query, and it allows you to bring it into, for lack of a better word, a data model. It sits behind the scenes, it brings your data in, and then it, first of all, is much faster than working with data tables. And it allows you to do two things. One, it allows you to build measures, and it allows you to build KPIs. Unfortunately, this conversation is just to acquaint you with the power that you currently have on your desktop to analyze data. So a lot of things that I mentioned I'm just going to have to gloss over. My suggestion would be is if you're responsible for dealing with large amounts of data, and you want to be able to gather it, transform it, compile it, and create some of those visualizations that we've been showing you through the course of these presentations, then you need to access these tools. There's a ton of training out there that you could access, but they're really fundamental tools. You don't have to get Tableau, and you don't have to get Tableau license, and you don't have to get Power BI by Microsoft and get their server. It's sitting on your desktop. The functionality that is in Excel is the same functionality as their enterprise level business intelligence tools that live in Microsoft BI. And so these are at your fingertips. So what did we show you? Pivot table. Functionality that allows you to summarize and filter large amounts of data. Here's a filter context. So what we said is, give me information on Patrick, give it to me on month, and sum up these following things. Now, inside of a normal pivot table, it would be very difficult to generate a show rate, because the show rate, you have to know how many were scheduled, how many people showed up, and you have to generate that number. Well, that's variables from maybe in different places. So with the Power BI, with the business intelligence tools in Excel, you can build a measure that when you bring it into your pivot table, if I change from Patrick to somebody else, this measure is going to continue to show me the show rate, but it's going to be showing me the show rate for a different person. CPT unit is a measure. Percentage of billable hours is a measure. These are fundamental. They take your ability to aggregate data well beyond what you can do in a normal pivot table. And here's a pivot chart. All the charts that we showed you were a pivot chart. You create a pivot table, then you go press a button, and it creates a chart. And so you can have a pivot table, and you can have a pivot chart, and every time you refresh your data, it'll refresh your pivot table, and you'll refresh your chart. So in the chart, you have a more structured way of looking at data, but you also have the visualization. The visualization is going to show you trends. It's going to show you something that's going to be easier to understand. You can build conditional formatting in there, and so you have an ability to really visualize your data. And all these little up arrows, that's part of just a visual conditional formatting to the cell. You said it. We said this. Okay. Although we wanted, what we have here is his billable hours is at 95%, and what we're saying here is that's good enough for us. He fell down as low as 70%, but based upon his performance, that's good, because what we're doing is I'm at 95%, and so we have a little visual piece. The third is get and transform. It's a query tool. We connect to multiple data sources, combine, transform, shape information to be used for analysis and data visualization. And this is just a screenshot of the functionality. This all lives under data. I think that's actually the query. I find it to be a very user-friendly and intuitive interface. If you've done any kind of querying or used any kind of querying tools, this will be a slam dunk for you. It's a pretty simple tool to use. And the final piece is Power Pivot. And it's an add-on, and it enables you to import large data and create relationships, calculated fields, measures. So my recommendation is if you have Excel and you're responsible for managing large amounts of data, particularly financial data or outcome data or billing data, payroll data, anything like that, you need to look into these tools. So, I'm going to just take a second. This is part of the process. We always ask people at the end to do a little bit of a self-assessment, and that sort of helps you focus on areas. I try to pick out the really important pieces here, helps you focus a little bit. So, does your financial leadership provide regular, timely, and easy to understand financial reports? Hopefully everybody is yes. It's not necessarily yes and no. It could be yes most of the time. It could be yes for some programs, or it could be no. If the answer is not, at least yes in important circumstances, that's something that needs to be addressed. Do you think that in the main staff understand the role they play in financial stability and sustainability of your organization? I ask that question because if you're sharing this data with your clinical leadership and clinical supervisors, then they can communicate this to the staff. So they understand the role they play. And so why is productivity important? So they understand why productivity. Why are we monitoring? Why are we asking you to do these things? I think that if you're looking at data regularly, they will understand that. Do you have key performance indicators that you track regularly? We saw in the poll that most of you do. Key is key. We have limited bandwidth, and we have limited ability to make changes. Sometimes we overanalyze. I'm a firm believer that you can identify what's important and what is critical. Start there. Don't go, let's not go too far down the road until we identify what is really important. Bring forward the data on a regular basis in a timely and manage against that data. So do you train financial staff on the use of Excel tables and pivot tables to filter and summarize large amounts of data? I sometimes do assessments of financial operations. I am known to go into an assessment, and the first question out of my mouth to the staff is, who knows how to do a pivot table? And if nobody raises their hand, I have a reasonable evaluation of skill sets for finance. Now, that might overgeneralize a little bit, but I do think it's absolutely, pivot tables are absolutely critical and essential skill set to have in your financial shop. Does your organization use the business intelligence tools in Microsoft Office? I would not Excel. I would not expect a lot of you to answer yes. I hope some of you answer yes. And I would hope that for you data geeks who are not aware of this, that within 5 minutes after I'm done talking, you'll be Googling them and getting a better understanding of what they are. And if no, do you think this skill set will be helpful for you manage your analyzing your data? I'll guarantee you it will. So next steps, complete part 4. Use your action plan template to at least set one goal that you may want to address. We are scheduled one more office hours. I know a lot of you folks haven't been showing up to office hours, and that's fine. It's certainly not mandatory, but it is an opportunity for you to talk directly to Trish and I to answer some questions. I think some of the folks that came to our office hours last time, I put together some simple tools on the fly that we provided. We provided some additional information. I sent them a reference for some training as it relates to the business intelligence tools. So it's not necessarily questions. It gives us an opportunity to pick our brains a little bit, go a little bit further than we're able to do in these presentations. And that's scheduled for Thursday, 11th, 9th. The link will be in the PowerPoint, and you can figure out whether you want to join us. So that leaves us, we timed this, that leaves us 8 minutes. So I'll ask the first question that came into the chat. Please feel free to chat in any additional questions that you may have. So the question was, can you talk about how best to respond to situations where the issue really is that the budget wasn't great? All right, this is a reference to actual to budget analysis. And you did your root cause analysis, and you dug in, and you're looking at actual, and your conclusion is that you did a poor job budgeting. So the first thing that I would do is I'd ask myself why we missed this budget. What can we learn from the way that we set this budget up? Was it that we missed something? Is it we weren't looking at trends? Was it that we compared to last year, and last year had anomalies in it that we didn't take into consideration. Did something happen externally that was outside of our control? So the first thing is to understand why the budget was poor. And then you really have two options. One is that you can go in, and I've seen organizations go in and reset their budget. And basically go in and say, we made a mistake when we built the budget. And what I don't want to do is answer the same question every single month of why is this off? It's just easier to go in and say, okay, we made a mistake with the budget. Let me fix that. We'll go in and we'll reset the budget. Hopefully, the way that you're pulling your budget data, you can go in and reset your budget and then reset that data in your data visualizations very quickly. And because if you're using the BI tools, that process can be automated. The other way is, and I've seen this done too, is you put a footnote. And so you don't have to answer the question, this variance is based upon this, this, and this, and it's a poor budgeting process, and, we're going to fix that going forward. So it really is a matter of how you want to do it. I mean, resetting the budget is fine. I normally didn't do a lot of that because, we never missed our mark significantly enough to do that. But I think the important question is, what did you get? Why did you get it wrong? And how can you make sure you don't do that again? And that was the only question that we got in that I saw through the chat. Any other questions, comments, concerns? Nothing? Okay, that's fine. Well, I'd like to thank you for attending our 4 sessions. Hopefully you found the information to be useful. If you did find some gaps in your systems, I really recommend that you carve out some time to address them. I mean, time, everybody is pressed for time. But what we don't want to do is we don't want to fix these problems when they're too late. So if you found gaps, see if you can carve out the time, bring your team together, put together, understand what it is, use the tools that we've been talking about to improve your quality, make changes. You can do them incrementally over time, but at the end of the day, what we really want is a very strong infrastructure. We really, in these presentations, tried to focus on what really is important, and I hope you found that useful. So with that, we're going to give you a couple more minutes back in your life. Thank you very much. Please join us for office hours. We'll probably do a little bit of a review. Again, you have an opportunity. We can go a little off topic, and it gives you an opportunity to ask questions that may not necessarily been against content that we addressed today. So we hope that we'll talk to you then. If we don't talk to you, again, thanks for joining us. Take care. Stay safe. Bye now.
Everybody.